Hello everyone, welcome to price action trading. This is going to be a complete series on price actions. In this series, we will be learning what price action is all about, what are the essential components of price action, how you can incorporate price actions into the trading setup, and many more advanced techniques that you can employ in your trading system. Right. First question is that what is price action? Of course, it's a very huge topic, vast thing to cover. Many different topics spans across. So we cannot complete this in one single video. We will have to split it and then cover it over like 5 or 6 videos, which I will be planning. And this is going to be part one. In this, we are going to see what price action is all about. So, what is price action? Let's try to understand the basic definition of a price action. Price action is simply stated you go back in time and see what market has done in the past, interpret the data, and see how you can make sense of what would be the futuristic moves. Right? The objective of this is to predict the direction. Whether the market is going to consolidate, is it going to go up or down? We are going to figure it out using price action. And it is a very reliable system. It employs various techniques, which we will see in the next slide, to make better trading decisions. Apart from that, what one has to keep in mind is the foundation of price action is all about going back and see what are the patterns that has been formed in the past and how well it has been respected currently and how well it might respect in the future. That forms the foundation of price action. And then it gives very little importance to fundamental analysis. You don't go by the stocks and see what is the P/E ratio, what is the performance of that company. Nothing matters because all the factors are assumed to be reflected in the actual market price at the moment. So you don't really go back to the foundations of it to figure out what would be the uh, reactions of fundamentals into price action. So that is all assumed to be factored in. So price action basically is considering various patterns that has formed in the past and see how well it is going to react in the future and where the market is likely to move. Because as an option buyer or as an option seller, all you want to know is where the market is moving, basis which you can bring out many different strategies, correct? So price action enables us to do that. It is a lot more reliable than any other indicator studies and other means of decoding where the market would move, because the indicators are all most of the indicators are lagging in nature, meaning after the prices have moved it will show that yeah, the market is going up or down. But price action helps us to determine how far can it go and whether it is likely to stay in the range or it is going to break up or break down. It is giving you a consolidated outlook of where the market is likely to move in near future. So that is what price action is all about. So next thing that we need to get into is to figure out what are the components of price action. This is a very important thing to understand because price action is not one single thing. It encompasses various factors. And what are those factors we are going to see now? It involves candlestick patterns. So you will be seeing some examples of Bank Nifty. I will explain each of this through that example. But having said that, candlestick patterns you should be aware of. So what are these candlestick patterns? In candlestick patterns, you have the open, close, high and low, and each candle tells something about what has happened in the market. When you club 2 or 3 candles together, it gives a lot more additional information, whether there is momentum on the upside or on the downside, or it is consolidating, is giving you a lot more details. When you club 2 or 3 candles together, you get more information about the market's direction. And then there are also trend lines. How to draw trend lines will be a separate part. So for each of it, I will have to make a unique video. Uh, so I will see how to fit and address all of this in depth as a separate part. But for now, trend lines. What are trend lines? Trend lines indicate that there is a particular direction in which the market is trading, and can you connect those dots and see where the market is heading? That's what trend line is all about, and I will give you some examples of that as well. Then there are demand zones and supply zones. So what are these demand zones and supply zones? Where the market, so there are big players who would not be entering anywhere just like retailers like us. They will enter at a very specific point, and then they will also exit when it reaches a specific point. So what are those points? What are the places in which the big players aggressively get into the trade? That is going to be the supply zone and demand zone. And then there is natural support and resistance that is also from the past data that you can figure out. As soon as market reaches a specific levels, it finds some sort of resistance and market comes down, and as soon as it reaches a tip, it again finds some sort of support and bounces back. So what are those support and resistance points? So how is it different from demand zone and supply zone? That we will see. And then there is also Fibonacci retracement, which principally says that after any sort of market directions, upside or downside, after a significant move, the market has to retrace, because it market is not linear. As soon as the market goes in a particular direction for some time, it has to lose some of its gain in order to go further, right? It's like running into an under 100-meter race, where you just run 1 kilometer, I mean 100 meters in say about 12 seconds. You cannot simply multiply it into 10 and say that I will be able to complete in 120 seconds, 1 kilometer in 120 seconds. It doesn't work that way, right? Similarly, market, if it has to move from point A to point B, it cannot just like that run in a straight line. It has to go up, dip, take some pause, and then again go. So what are those levels? How do you arrive at those levels? That is Fibonacci retracement levels. I'll show some examples on that as well. And then from the past data, you also have standard pivot points where the market makes critical decision, whether it should move further higher, or is it going to be tested, or it is going to consolidate. There are certain pivot points in which the market makes a decision of whether to continue with the trend or to reverse from that. So those are the standard pivot points that will also be part of price action. And then there is gaps. Suddenly the market opens 200 points plus, 300 points down. There is a momentum that shows at the very beginning itself. These gaps are also going to play a very significant role in establishing price action. Apart from that, when you club all this information, the market may be saying, it's going to go up. But then there is a sudden event, and then some sort of scams or some sort of global decisions being made. The market suddenly disrespects every pattern, everything, and then moves in the opposite direction. Why? Because the collective psychology has changed, and it doesn't respect any of the trends or support lines or demand and supply zones. So the events and news can be a very significant factor when it comes to price action trading. So these are the various components that one should be aware of in price action trading. I hope that clarifies. The next part that we are going to see is the example. So what we have here is the chart of Bank Nifty. As you see that the market has been moving up, and then it reached here, then it retraced back, then it reached here again, it lost its gain, and then suddenly it went all the way down. And as soon as it reached again here, it's finding resistance here, right? So this is in a 1 hour time frame, and here is where the market has been rejected. This is also the lifetime high. So twice it got rejected here, and third time when it attempted to break, again it got rejected, establishing itself as a strong supply zone. I will be making another video dedicated to how to draw supply and demand zones. That will be a separate video because it requires so much of depth. In a nutshell, this is how you arrive at it, because there is a lot of time frame study that you will have to do. You may have to analyze in 15 minutes time frame, 1 hour time frame, 4 hours, 1 day, and 1 month sometimes, to arrive at the supply zones and demand zones. So how to do that I will show in a separate video. But for now, the basic principle is that, many times that it has been tested, and then there is an aggressive, reversal happening at one point that acts as a supply zone from the top, and at the bottom, if it happens, it acts as a demand zone. So that's where the big players are interested in buying more. So this is supply zone, and you have demand zone over here, because here is where the market found its support. Second time it went up. Third time it came down, and then it went up. Fourth time, as soon as it reached here, it just fired up. So this is how you arrive at the demand zone and supply zone. The next part is pivot points. Pivot points are very simple, whichever time frame that you choose, and then there is an indicator called standard pivot points. When you enable that, it will calculate 14 instances of the time frame that you have chosen, and then goes back in time and computes where the market has made significant decision, the pivot point, right? And where is the maximum resistance, R1, R2, R3, R4, R5, and S1, S2, S3, S4, S5. So 5 supports and 5 resistance that it gives. It keeps changing on a daily basis based on the time frame that you choose. The levels could vary. Principally, this is more of to say where likely you will find some support and resistance on an intraday basis. So standard pivot points is one significant factor to be considered in price action trading. So far we have discussed supply zone, demand zone, and standard pivots. The next important part is the trend line. Trend line is not so obvious. You got to be very analytical. You got to see where in the chart there are points that forms a straight line, straight path. Then there seems to be some sort of support or resistance. In this chart, if you see, probably I can connect these lows and then draw a trend line over here. And here it is very evident that the peak of this, there is one more rejection here, one more rejection here, and then there is one more rejection. As soon as it breaks the trend line, it went up significantly, but it never retraced back to this trend line, and the market continued to go up. So a trend line is where the market decides whether it should play within that range, and once it breaks, it indicates a reversal of trend, right? So trend lines are something that needs to be practiced, and how to draw a trend line, we can discuss that in a separate video. Basically, in this video, we are going to cover only the essential components of what constitutes price action, right? So the next one is the Fibonacci retracement. So what is the Fibonacci retracement? Like I said, you cannot run 1 kilometer at a stretch, right? Like just because you can run 100 meters in 12 seconds doesn't mean that in 120 seconds you will run one kilometer. The market is never a straight line. It always comes down, goes up, comes down, goes up, and then it is always a flex, right? And when you draw the peak to the base of it, the Fibonacci retracement says that there are 3 critical zones that you should watch out for, retracement zones. One is 0.38, another one is 0.5, and another one is 61.8 percentage. That is also called as the golden ratio. If you have not seen how to draw this Fibonacci retracement tools and how to use Fibonacci tools, then there is a video that I have already made. I will give you the description, as well as give a card. You can just watch that link, and that will enable you to understand it comprehensively. It's a 2-hour long video. Please go through that. It's going to really elevate your understanding of how Fibonacci tools work, right? So Fibonacci retracement will, if you look at this, market has fallen from 46,000 to 43,500 levels. So there is a retracement. The retracement happened to the levels of 0.5. Again, it came down. Again, it went and retested 0.38. Came down multiple times. It retested 0.38. And as soon as it cleared, point 618, market continued to move up and reach the same levels as before, right? The previous high was retested. So Fibonacci retracement also enables us to determine the market directions. The next important part that we should also consider is, here is one example. There are also certain chart patterns that's formed, which we will have to give significant weightage. In this chart, if you see, there is an head and shoulder pattern. Here is the left shoulder, head, and then right shoulder. Now, this is an inverse head and shoulder pattern, right? The head and shoulder is usually M shape, but here you see there is a W shape, right? So this is inverse head and shoulder pattern, which indicates that there is a strong up move about to come, and which exactly happened over here. The market continued to rally, and since this is the 1 hour time frame, the reliability of these patterns are much higher than say 1 minute or 3 minutes or 5 minute time frames. So these patterns also add lot more weightage to predict the market directions using price action trading, right? Now this is one pattern. There are countless number of patterns, maybe cup and handle. There is parallel channels, symmetrical channels, flag and pole, flag and pendant. Many different patterns are there, which will be covered as a separate, technical chart patterns. I will make a series. It's already there. One video has been made. I will give a link to that as well. But I will go in depth and then add more patterns, and then how to interpret that, and how do we know what should be the entry, stop loss, and the targets. I will make some separate videos on most essential chart patterns. So that is again going to contribute very significantly in determining where the market is going to go. The next part is most important part, the market gaps. You see, this is the close, and the next day market gap down. There is a huge gap, right? There is a huge gap, more than 300 points of gap over here. Now these gaps are very critical in determining the future moves. Why? When you see a gap much wider, the wider the gap, the more momentum on that side is. So when the market gave this gap, you see that until then there was some sort of support going up and then coming down again, pulling up, and suddenly there is a gap which cleared this level. Immediately you see that massive downside move had come, right? Whichever side there is a gap, and then there will be a continuation. Most likely there will be a continuation. So gaps play a very significant part in determining the market momentum and directions. So the next part is candlestick patterns itself. So when I said that each candle reveals a lot more details about where the market is heading, when we club 2 or 3 more candles, it gives even more higher perspective about the market's future moves. In this candle, if you see, the first candle is a red candle, second candle is a red candle, and third candle is a red candle. Each one is making a newer lows, and then it's continuing to make strong breakout on the downside, and then the trend continued. In fact, it is this trend which gave a small retracement and then brought the market all the way down, right? And this 3 candles of subsequent candles of red, each one making newer lows, is called 3 black soldiers. There are similar patterns, many different patterns are there. When we do a complete comprehensive study on candlestick patterns, I will cover more such uh, candlestick patterns into that series. But basically these are the various components of it, which determines where the market is heading. So if you look at it, what determines the price action? There is a supply zone, there is a demand zone, right? There is a support zone, there is a resistance zone. As you can see here, there is a support and resistance. There is also Fibonacci retracement levels that will enable us to determine whether the market is going to be, is it a reversal or it is a retracement. It's going to help us to find out that. And then there are also chart patterns like head and shoulder, cup and handle, and many other patterns that might be formed that will give us some sense of where the market is heading. And then there is also standard pivot points, which enables us to determine where the market would find critical decisions, and then whether it is going to be supported or the support is going to be broken. All such factors adds on, and on top of that, you also have patterns with the candlesticks itself. So all these collectively put together determines where the market is heading. Now, there are people who have studied Fibonacci retracement but not have studied demand zone and supply zone. There are people who have studied supply zone and demand zone but not gone into the depths of candlestick patterns. Now, these are the people going with their understanding of the market, places and punches the order on a daily basis or a positional basis. And collectively, it is all these reactions happening together is going to determine the market move. And the stronger view is, the direction is going to be much fierce in that particular side, right? So, in a nutshell, it is a combination of all of these elements: candlestick patterns, trend lines, demand and supply zone, support and resistance levels, Fibonacci retracement, standard pivot points, market gaps. Now, one thing that is excluded here is events and news. Because when all of this, suggests, let's say, let's go back here. Let's say that, the market has given an head and shoulder pattern here, and then it is also breaking this, Fibonacci retracements levels, everything is all fine. And then you are expecting the market to go up. But suddenly, government comes up and says something, some economic news is coming which is not in favor, for it doesn't look great. Suddenly there could be a fall beating all the odds, the gaps, supply zone, demand zone. It will break everything, and then it might go on the downside. So price action is extremely brilliant when you club all these details together. But at the same time, you should be aware of the fact that when there is some sort of event, nothing might work, right? No data would work, no patterns would work. So you should be aware of what is the limitations of price action trading. The price action trading cannot determine the outcome of events and news, right? Sometimes it might be in line with the news, sometimes it might go against the news, and those movements may be in line with the price action forecast, or it might be against it. So that is one thing that you should always remember. Price action trading works brilliantly on most of the days. The days where it cannot be relied upon is the day where there is events and news based things are expected. So that summarizes us, that brings us to the end of this first part, and then let's summarize it and see. Yeah, price action essentially is consolidating the human behaviors and then how market is being perceived. What are the sentiments of larger part of the people in the market? Also, it helps us to forecast not only the direction, but to the extent it can move, right? It's not just uptrend or downtrend. It also can say that till where it can go, right? That is price action. And sometimes when you use indicators like, stochastics or RSI, it might be saying oversold, overbought, or, trend is reversing, something like that it might suggest. And then you might see some sort of, breakouts happening. But later you realize that it is a false breakout, because if you rely upon one single indicator, the chances of you to go wrong is significantly higher. The excellent way to curb those noises and then almost eliminate all this false breakout is through price action trading. And this way it is more reliable, it is very flexible. You have some sort of trade setup, you have some systems. Now along with this, if you club this price action trading, it's going to be far more superiorly powerful than what you are already doing. So that's the nutshell about price action. In the next series, in the next video, we will be going into the depths of price action trading and explore a lot more advanced concepts. So thanks a lot for watching. See you in the next video.